Welcome to TrustCore's special presentation focusing on the current historic market environment. The last few weeks in the financial markets have been among the most volatile ever, rivaling periods surrounding the 1929 and 2008's Great Recession. If we had to write one headline, it would be the following. The COVID-19 virus pandemic has caused the fastest equity bear market in history and driven U.S. government debt prices to all-time highs. My name is Gary Dean, and I will be the narrator of this presentation. I am the CEO of TrustCore and serve as a member of our investment committee. Our investment committee works with our research department to serve your TrustCore advisor in building your investment portfolio. For the next 20 minutes or so, our objective is to give you some context on why this volatility has happened, outline the current state of play in markets, and offer you some guidance on how best to navigate this critical time. We know the current market environment can be very unsettling, and this is a normal reaction. We hope this presentation can help to calm fears and refocus you on the long-term opportunities ahead. So let's get started. Here is an agenda on what we will cover. First, we will spend a few minutes covering the market setup coming into this crisis. One of the most unique features of this crisis is it has represented the fastest 10, 20%, and 30% equity market corrections from an all-time high in history. Understanding what the market was discounting right before the COVID-19 virus appeared on the scene can help us process the speed of this pullback and perhaps make it a little more understandable. Second, we plan to dive in and look at the current state of play in markets that have led to some of the most extreme readings in history. Finally, we will look at some behavioral finance data and offer you some encouragement to help fight one's natural instincts that while completely normal can harm your ability to succeed and reach your long-term financial goals if they are not recognized and held in check. Go to slide 3. So let's set the scene. To do this, we need to start with the Fed. The U.S. Federal Reserve has been the primary actor throughout the economic recovery from the Great Recession of 2008-2009. The Fed deployed an aggressive policy and expansive toolkit to try and stave off a depression after the 2008 market meltdown. The Fed is the lender of last resort, and in a time of great financial distress, did a good job of providing liquidity to the market and enabling our recovery to take shape. The Fed's toolkit included a move to zero interest rate policy, commonly called ZIRP, and the purchase of financial assets, commonly called quantitative easing, or QE for short. In May 2014, a full 5 years after the height of the crisis, the Fed had effectively lowered interest rates to -3% when combining the effects of ZIRP and QE. At that time, the Fed made the judgment that the economy was strong enough that it could begin to tighten monetary policy. The Fed's first step in doing this was to stop quantitative easing. Then, beginning in 2015, it began to raise the Fed funds rate above zero and kept gradually raising this rate until November of 2018. You can see the Fed's tightening actions in this chart by the pink arrow calling out the 5.4% or 540 basis points of Fed interest rate tightening from 2014 to 2018. Now, let's introduce the next actor in this drama, Trump's trade war. The following chart shows the S&P 500 index from January 2018 until its all-time high in late February 2020. After a strong market year in 2017, President Trump decided to attempt to fulfill one of his key election promises of crafting a new trade relationship with China. In typical Trump style, his approach was very confrontational, abrupt, and hard to predict. Early in 2018, he began announcing a series of tariffs on Chinese imports. Not surprisingly, China responded in kind with tariffs on U.S. goods. The trade war slowed the global economy and caused equity markets to move sideways to down for much of 2018 and 2019. Building off our last slide, the trade war was layered onto a Fed that was executing its 4-year interest rate tightening cycle, continuing to raise rates throughout 2018. As the economy slowed through 2018, the S&P 500 finally gave in to this negative 1-2 punch of a trade war and Fed tightening, and we had the 20% bear market of the fourth quarter of 2018, the low point of which is shown by the horizontal red line on the chart. In 2018, no major asset classes other than cash showed a positive return. As we entered 2019, the Fed realized it had gone too far in its tightening policy, causing Chairman Powell to pivot and begin to ease interest rates mid-year. Moreover, the US and China reached a phase 1 trade deal that eased some of the pressure on the economy. The result of this combination was an upward breakout in the market in September of 2019, the starting point of which is shown by the horizontal white line on the chart, and then a move to an all-time high in February 2020 on the expectation of improving global economies and corporate earnings. In 2019, every major asset class showed a positive return. It is from this very optimistic market moment that our antagonist, the COVID-19 virus, entered the picture. So we'll move to slide 5. The COVID-19 virus began in the Hubei province of China in late January of this year, just less than 8 weeks ago. The US equity market initially sold off about 5% on this threat. But as the number of new cases in China began to decline in the first half of February, you can see this on the blue and yellow lines on the chart, and fantastic corporate earnings were being reported by US companies, the market rallied and made an all-time high. China had deployed draconian measures to stem the growth of the virus, and it looked like they may have succeeded in containing it. That all changed once the virus made its confirmed leap outside of mainland China in late February. See the red line in the chart for new COVID-19 cases outside of China. At this point, what the market incorrectly thought had been contained within China rapidly took on the makings of a global pandemic, bringing with it the risk of huge disruptions to daily life and the global economy. The world was quickly coming to terms that it would have to take many of the draconian measures that China had taken to stem the spread of the virus. The market had a new, unprecedented type of risk to discount, and it moved with the greatest speed in history to accomplish its task. Move to slide 6. As you can see in this slide, did it ever move quickly to do this? The following chart shows the S&P 500 index over the last year. The sudden arrival of the COVID-19 virus onto the global scene at a time when the market was breaking out of a 2-year range and making a new high created a combustible cocktail that resulted in the fastest 10%, 20%, and 30% corrections in history. All 3 of these accomplished in less than 30 days. So far, the S&P has corrected 35%. The Russell 2000, an index that captures smaller capitalization stocks, has corrected over 40%. We're going to try and not overburden you with charts, but let's take a moment and look what has happened with a few other major asset classes over the last month during this crisis. In times of great stress, global investors often flock to the perceived safest investment in the world, US Treasury notes. As this crisis has rapidly unfolded, global investors have pushed the prices of US Treasuries to all-time highs. With bonds, price moves opposite of interest rate yield. So on the 5-year chart above, you can see the yield on the 10-year US Treasury note drop to an all-time low of 0.5%, as close to 0% yield as it has ever recorded. Diversified fixed income portfolios typically contain government bonds and corporate bonds. One of the reasons the fixed income portion of portfolios has performed relatively well during this COVID-19 crisis is the strong performance of government bonds as investors chase safety and bid up prices. Corporate bonds have been a slightly different story. Investment-grade corporate bonds are bonds that are rated BBB or higher by the major rating services. They carry very little risk of default. Typical companies with investment-grade ratings would be Apple or Berkshire Hathaway. This chart shows the spread of an investment-grade bond index over the U.S. 10-year Treasury yield. Said another way, it takes the yield of an average investment-grade bond and subtracts the yield of the U.S. 10-year Treasury to give a picture of how much more yield one is getting over the safest bond in the world. For most of last year, this spread was about 1.2 to 1.5%. Over the last month, this spread has almost tripled to 3.3%. As a result, the overall yield on investment-grade bonds has increased and their prices have fallen. So in a typical diversified fixed income portfolio, this has been a negative contributor to performance over the last month. We haven't included a chart to show it, but if one looked at the high yield corporate bond market, those issues rated below BBB, the spread in that market above the US 10-year has blown out to close to 11% from an average over the last year of 4%. Once again, this has caused prices in the high yield corporate bond market to fall, which leads us to our last slide on major asset classes, oil. If you're looking for names to mark off your Christmas list for 2020, the President of Russia and the Crown Prince of Saudi Arabia would be two names to go ahead and put a line through. Right as the COVID-19 virus was taking full flight, these two gentlemen decided to start a global oil price war, breaking the OPEC supply agreements. Putin is interested in trying to bankrupt as many of the US-based shale producers as possible, as he views their supply production as holding the global price of oil down. He sensed an opportunity to inflict a lot of pain on these US shale producers by piling on to the COVID-19 market panic. The energy sector makes up a much larger percentage of the US high-yield bond market than it does of the equity market. The current price level of oil will lead to many bankruptcies in the energy sector if the price remains at this depressed level for several months. Current prices are below profitable levels for Russia or Saudi Arabia, so it is widely thought to be a temporary price depression. Okay, the last chart to set the current historic scene. This chart shows the S&P 500 volatility index. It is a measure of the expected volatility of the return of the S&P 500 over the next year. For those of you who took statistics in high school or college, it is the expected standard deviation of the market return over the next 12 months. The VIX is commonly called the fear gauge. Typically, it registers between 15 and 20%, but in times of market stress, it can spike to 30 to 40%. In the 2008 financial crisis, the VIX spiked all the way to 87%, the highest level in history. On a personal note, I never thought I would see in my career again volatility like the 2008 crisis. I was wrong. Last week, the VIX came within a hair of the 2008 high, registering at 85%. To give you some sense of just how extreme this volatility is, a VIX of 85% is telling us to expect daily price moves in the S&P 500 of 5.4%. Also known as the roller coaster we have been living through over the last couple of weeks. As shown in the chart by the red shaded areas, large spikes in the VIX above 30 are usually accompanied by large sell-offs in global equity prices. This time has been no different with our 35% sell-off. So let's finish with the data charts and pivot to some practical comments, such as what you should be looking for to begin to see markets stabilize and what you should be doing during this time. 2020 has started off as a very crazy year, but it is only March 24th. There are still 9 months to go to put a bow on this year. If we can travel forward in time, what are we likely to see is the turning points in this crisis towards stabilization in markets. What are we likely to chalk up as 2020 hindsight? We would offer up 4 things to be watching closely. First is the virus data itself. We need to see an improvement in the data on the virus fight. Italy is a couple of weeks ahead of the US and one to watch as a harbinger. Second, the market needs some sense of how long the social distancing driven economic shutdown will last. We are in day 9 of the president's 15 days to slow the spread campaign. Does this get extended, and by how much? The president is signaling he wants business back up and running by Easter. Does he have that power, or are the state governors more in control now? These are all questions that need answers. Third, we need estimates to stop going down. Earnings per share estimates on the S&P 500 started the year around $175. Right now, they are between $125 to $140. Likewise, GDP estimates for the second quarter have been leapfrogging down rapidly, with some analysts going to down 25 to 30%. Truly unprecedented levels. Seeing these estimates stabilize is critical. Finally, we need help from the government. The Fed has already stepped in, bringing back ZIRP and QE and other crisis era tools. Congress is close to finalizing a fiscal stimulus bill that is equal to about 10% of GDP. This needs to get passed soon. After the virus left China, Italy became the new ground zero. It has been especially hit hard by virtue of its demographics, population density, and climate. In an encouraging note, daily new cases have declined for the last 2 days. The markets view Italy as being about 2 weeks ahead of the US, so case growth slowing and rolling over is seen as a potential precursor to the US experience and a key to market stabilization. Now let's pivot to what you can be doing. Daniel Kahneman and Amos Tversky famously won the Nobel Prize in Economics for their work in behavioral finance. Their first major research breakthrough was called prospect theory. The book Thinking Fast and Slow, shown here, details their work. Prospect theory, simplified, says that losses hurt us emotionally far more than gains give us pleasure. Kahneman and Tversky quantified this to the point where they said individuals weighted losses at twice the weight of an equivalent gain. Humor me for one moment on this. Ask yourself if this is true for you. Last year, the S&P 500 was up 29%. This year, the S&P 500 is down 25% as I write this. So roughly the same return. Does it feel like the same return to you? Doesn't the pain and fear from this year's sell-off feel much, much worse than the joy you felt from last year's positive return? If it does, you are completely normal. This emotional response is coded into our survival instincts. This paradox of emotions you are feeling is prospect theory. And what it does to us is cause us to not want to take risk or even to become reckless when we are experiencing losses, because the perceived pain is greater than our actual pain. Cutting our losses or becoming reckless as a response can harm our ability to succeed in the long run. This chart shows the last 40 years of S&P 500 returns, along with the maximum percentage drawdown experienced in each year. The drawdown is shown by the red dot and the red numbers in each year. We don't yet know what the final numbers for 2020 will be. So far, the drawdown is among the more extreme, but not the worst. That distinction still belongs to 2008. We saw similar 34% plus drawdowns in 3 other years. In those years, it took around a year or 2 before the market was able to respond and make a new high. What this chart tells us is each year, and some years more than others, you are going to be hit by the implications of prospect theory. Everyone instinctively wants to time the market. Buy low, sell high. The problem with this is it has been proven to be very hard to do with any consistency. Warren Buffett has become the most successful investor of our time by deploying a robust buy and hold philosophy. For equities, this chart shows that the longer you stay in the market, the greater your odds are that you will experience positive returns. If you had monthly holding periods, the circle on the far left, you had a positive returns 62% of the time since 1970. If your holding periods expanded to 10 years, the circle on the far right, you experienced positive returns 95% of the time since 1970. If you hear one thing from this presentation, hear this. Time in the market is more important than timing the market. I'm going to repeat this. Time in the market is more important than timing the market. To put some emphasis on the last slide, this slide shows you how your return would have been impacted over the last 20 years if you've been out of the market on the best 5, 10, 15, 20, or 25 days. Missing these up days is critical to returns. For an example, the chart shows that if you missed the 10 best days of the last 20 years, but were in the market every other day, your return would have been cut in half versus being in the market every day of the last 20 years. In the midst of volatility like we are in now, recall we said the VIX was forecasting expected daily moves in the S&P 500 of 5.4%. Those are big swings. You will see big down and big up days. This chart argues that you need to be there for both. Missing even 5 of the best days, which can typically come at market turning points, can devastate your return. To put an exclamation point on this point, today's 10% move in the market was the best percentage gain in the Dow Jones Industrial Average since 1933. You want to be there for these days, even if they are in the midst of a storm. As we alluded to earlier in the presentation, at least one major asset class is having a positive year, U.S. Treasury notes. It is good to remember that diversified portfolios compete well over time and help us to smooth out the ride of an all-equity portfolio. The table on the left of this chart shows the returns of the S&P 500 and a diversified portfolio over the last 20 years. At different points, the diversified portfolio underperformed or outperformed the S&P 500. But in the end, you got to the same place with much less volatility. So let me begin to wrap up. This slide outlines the core tenets that TrustCore utilizes to manage client portfolios. You will notice that correctly timing the market isn't on the list. We believe in investing for the long term with a globally diversified portfolio. What we are apt to recommend right now is staying the course to your plan, rebalancing to your investment allocation to utilize tax losses to your advantage, and opportunistically shifting within asset classes to take advantage of the extreme moves we have seen so far in 2020. We will end our presentation now. We encourage you to stay the course during this turbulent time. Our economy and markets are resilient. We encourage you to reach out to your TrustCore planner to discuss any elements of this presentation or any concerns you may have. We are here to help you reach your goals. Thank you for being our client, and thank you for your time today.